We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is David Hunter, Contrarian Macro Strategist with 52 years of experience. David, thanks for joining me today. How are you?
Yeah, hi, Tom. Long time no see. Great to see you.
Yeah, it's always good to speak with you again, David. And you know, it's always wild to think how many guests I end up speaking to before I kind of revisit and get updates from particular people. But you know, you and I have been speaking since basically I started or took over the show, and you've been consistent in your messaging about calling for a Meltup in the stock market here. So are we now in what you consider as, let's say, the final leg of this 43-year secular bull market?
Yes, absolutely. I think, I didn't expect the sell-off we had in early April, but I think that created another leg. So, you know, kind of like October of 23, and obviously the bottom in October of 22, we had this sell-off in April that took us down 20% in the S&P. Mm-hmm. And I think from there we have begun a new leg, obviously a very steep run out of that bottom in April. And I think, yes, this is the final, what I think will ultimately be a parabolic leg into a top this year.
So what do you think the catalyst is going to be to reach that top this year, David?
Yeah, I think surprisingly, we're still in a situation, in spite of the fact that we had the S&P run 40% plus off the bottom and NASDAQ more than that, in spite of a lot of new highs, you still have basically institutional investors very cautious and skeptical of this market. Yes, you're seeing some targets raised on Wall Street, but generally, I think institutional investors have one foot out the door. So I think until they're all in, this thing has legs, and you know, final leg. Not to mix up terms, but retail surprisingly didn't panic at the bottom and stayed, at least a good chunk of retail stayed bullish and has remained bullish here. And there, it's kind of a divergence here. It's surprising because usually everybody calls the institutions the smart money and the retail kind of the dumb money, but it's been in reverse here for the last couple months. And I do think that it is, from a sentiment standpoint, there is still a very big wall of worry that provides the fuel for the advance into the top. In terms of fundamentals, I think the narrative is going to be soft landing, no recession in sight, rates coming down. That's a bit contrary here, but I do think you're going to see a big drop in rates. And I think ultimately the Fed will join the party, whether it's in July or September. I think we're going to see a rate cut one way or the other. As I've said many times, rates are coming down without the Fed. So I'm not so caught up in trying to worry about whether the Fed's going to cut in July or September or whenever, because I think the bond market is already starting to take rates down. You know, they were 460 not long ago, and we're down to 440. They were down almost 430 yesterday, I think. So we're on our way down. I expect over the next probably 3 or 4 months that you could get down well into the threes, almost to 3% probably by fall. And that will be certainly an added tailwind for the market. I also think as we move through the summer and into the fall, we're going to see more and more of certainly Wall Street buying into the Trump policies and realizing that, yes, we are, tariffs aren't going to destroy things. We aren't going to see a big rise in inflation. The economy is actually slowing, so rates can come down. Inflation's still trending down, et cetera. I think the the recognition of how much deregulation is going to help offset the tariffs, how much the drop in oil price is going to help offset any inflation fears, et cetera. I think that's all going to come together here in the next couple months to help drive this thing higher. And at the same time, I think earnings are going to be still looking very good. So, not gangbusters, but intact, meaning, you'll have some growth in earnings this quarter, and nobody's going to be worrying that it's the end of the earnings cycle.
So just to kind of summarize that, David, you think that this secular top, I think is the right way to say it. Is that correct? Is going to be driven by the institutional money getting all in, and not by let's say a stimulative push by the Fed.
Yes, I think that's true. I think there'll be some stimulation from rates dropping, but in terms of money, I don't think see the big money surge into the system until after the top. So I'm not counting on a lot. The Fed is not a big piece of my rationale for why we're going to into a parabolic run here. I think the big money print that I have talked about with you and for a long time, that could be to the tune of $20 trillion in expanded QE, just out of the Fed, with proportionally like expansion elsewhere around the world, everywhere around the world. That comes in response to what I think is a global bust that is coming, but is just being put off until we'll go through the beginning of the recession, and then I think that morphs into a bust because of the leverage in the system. So I think both of those things are more or less 2026 stories. You could see recession, in coming months here this year, but it'll be mild enough that it won't push investors away.
Well, I think my question, as you're explaining this, is basically for institutional money to come all in here. That seems to be, let's say, based around confidence. So what do you think changes between now and then for the market to gain this confidence to be able to invest and really drive this thing to this top?
Yeah, certainly one of the things, even though I'm not focused on the Fed, the street is. It drives me nuts that they do, because I keep saying the bond market's in charge, not the Fed. But I think the recognition that inflation isn't doing these awful things because of tariffs, the recognition that Powell is coming around to the view that, hey, maybe we are restrictive and we need to get on board. It may come as a result of the economy getting softer or jobs getting softer, but I don't think it'll be so soft that it'll spook institutional investors. I think they'll see it as a soft landing, kind of the porridge is just right type of thing. And I think coming around to that view that, hey, the Fed's going to start easing will be part of the story, but it's not the driving part of the story. I think the driving part is really understanding, or not understanding, but coming around to, hey, Trump policies are good, not bad. They are pro-growth. They are going to help keep this cycle going. Not that it's necessarily true. I think the cycle ends this year, but I think that will be the narrative that drives the institutions into it. And then, as always, at the top, the sentiment is going to be all in. It's not that the sentiment causes the decline so much, but I think at the top, everybody will be all in. And the story at the top will be the Fed just started an easing cycle. We've got, at least 2 or 3 years to run. This thing's just getting started. I think that, and I'll be on the other side of that then, just like I am now, saying, no, this cycle is coming to an end. There's too much euphoria. It's time to take chips off the table.
Well, you mentioned that earnings are going to be reasonable, at least, and of course, that is going to provide some confidence to the market. But where do the jobs and the housing market rolling over here, where does that fit in to that confidence piece. We see we're continuing to see job losses, AI taking over all kinds of jobs, and on the other side of it, as I mentioned, the housing market really having record levels of inventories. There's record levels of delinquencies on mortgages, stuff like that. Like, what is going to give the appearance of a market that is worth being confident in?
Yeah, keep in mind that everybody's been hyper focused on interest rates being high and going higher. I mean, I think the street consensus is they're going up, not down, at least on the long end. Mm-hmm. I'm very much of the belief that in the next 3 or 4 months you could be 100 basis points lower in rates on your way to maybe even almost 200 basis points lower. And then from there in the bust even lower than that. But I think this first 100 basis points down helps create a bounce in real estate. So whereas everybody's kind of saying, hey, real estate's rolling over, and certainly mortgage rates have kind of dried up the buyers, I think you're going to see that there's still some pent-up demand there, that if you get mortgage rates down under 6% or down to 6% or under, they'll be thinking, hey, I got to grab this before they go to 8, So I think you could have, and I see it in the charts of the home builders, I think you could have the home builders go to new highs here. I have a 150 target on XHB. So I think, and probably the same can be said to some extent in autos. These are interest rate driven industries. And I think we kind of do too much linear thinking and just kind of straight line it that, hey, rates are going up. The auto industry is not going to do well and housing is going to do well. And yet you bring rates down for a little while and all of a sudden that takes away some of that fear of a recession. It may even take away some of the soft landing fear for a period of, months, and help boost confidence that, hey, the cycle's just getting started. Again, that's not my view of where we're headed, but I think for a few months it could look like that's where we're headed.
Right. Yeah, and I have heard that before, that kind of 5% mortgage rates are really that key level that brings a lot of buyers back into the market. But is that, rates coming down is obviously going to be driven by bond buying, right? So is that also a part of, this confidence piece that the market goes back into, or the buyers come back into the market in a meaningful way to be able to move these rates down because they're confident in the value of the dollar and the value of the bonds that they're going to be getting back in that tenure?
Yeah, I don't think it's so much foreign buying, which would be more dollar related. I think it's institutions, primarily institutions, starting to go longer out on the yield curve, stretch in duration, feeling more confident that rates have peaked and are rolling over. It ironically will probably be more about the economy slowing, not expanding. But at the same time the economy is expanding, some of those early cycle things like autos and housing will be starting to go the other way because of rates, and it'll give confidence that, hey, yes, we're slowing, but we're not going into recession, or this is kind of that rosy scenario we used to talk about years ago. It's you get your cake and eat it too. You got rates coming down, economies growing, but not growing fast enough to push inflation up. I think if you look at why are so many, when you hear the bears come out and talk, what do they focus on? They focus on inflation going up, that it's, we've bottomed out and we're heading back higher. Tariffs going to be part of that. They focus on the Fed and that the Fed's got no reason to ease for a long while yet. I think all those things will change in the next couple of months. And ironically, it will probably be because of a slowing economy. I do think tariffs are going to have some impact on consumers. They have to. We saw a lot of buying ahead of the tariffs. It's stolen some of the growth from the future, and the economy is already slowing down anyway. So I've even said, when we go back and date the recession, it won't surprise me if we find we've already started in one. Certainly factory orders and ISM indexes and things are in recession. The consumers held together, but we're even hearing talk about the high-end consumer, who's really been the buyer, starting to show signs of slowing. So I wouldn't be surprised if we get into recession by sometime this summer, but I don't think we'll know that for a while.
So when do you expect this top to happen? Is this like a September, October type time frame, do you think?
Yeah, I get myself into trouble because I always answer those questions and keep extending it. But it doesn't have to top in the next 3-4 months, but I think it very well could top in the next 3 or 4 months. And by the way, I just put out my third quarter letter, and I'm already way above anybody else's targets, anybody legitimate's targets on the market. I raised my target going into this letter on the S&P was 8,000. I've raised that to 8,700. My NASDAQ target was 27,000. I've raised that to 30,000. My Dow target was 55. I've raised that to 60,000. And I've raised my Russell 2000 target from 3,300, 3,400, just a little bit, but that one has the farthest to go, so I didn't feel like it had much upside there. But that's a sign. I mean, those are 40 to 50% moves from here for most of those indexes. That's a huge move to happen in 3 or 4 months. So I'm not saying it has to happen in 3 or 4 months, but I do think it's a 2025 event, and I do think it's more likely that it happens that fast because we're in the parabolic. I mean, if you look at the move from April till now, obviously in 2.5 months or whatever it is, we've had 40% plus move. I think the market, as you go to the top, is going to steepen more. It's going to go into a vertical. So if you can do 40% in the next in 2.5, 3 months, you can certainly do another 40 or 50 in the next few months. So that's my thinking. Again, there's no magic to a certain time frame. People seem to think there's a deadline, that we're in a race against time. If we don't get it now, we're not going to get it. I go, no. I'm giving you my best look at what I see out there, fundamentally, technically, flow-wise, and I think it can happen in the next 3 or 4 months. If it goes 6 months and you get anything close to a 40% move in 6 months, I'll take that and run.
Yeah, no doubt. David, when we think about the behavior of these markets, especially throughout history, when we've seen governments come back in, print to oblivion to try to stimulate, the idea of Weimar Germany comes to mind. And if you look at the chart of the value of the currency through that time, it's these wild bull and bear cycles that come with increasing frequency. So if this is, let's say, the final top, why do you think we don't get higher tops at more frequent rates, followed by lower busts, kind of this ever intensifying cycle until, let's say, the end of the US dollar, as many have put it?
Yeah. First of all, you're basically explaining what I've said many times, is that this is a culmination of all the decades since the Great Depression. Every successive cycle, we've had more excesses that would take more cranking down to take care of it, primarily inflation, but that would take more to crank it down, and then more to crank it back up because you went too far in each direction. And so each successive, or most every successive cycle, we've had to do more extremes in policy, both tightening and easing. So you're now at in that end game where we not only had to do so much in 2008-9, But then we had the pandemic in 2020 that you had, the mother of all volatility, right? I mean, it's gone to extremes that we never saw anything like before. As I remind people, the Fed balance sheet was $875 billion going into 2008's downturn. We got up to $9 trillion after the pandemic. So, we're back down under 7, I think, or 7. So, but what you're doing is I don't know, it's a sine wave theory. Somebody called it a buggy whip theory, but it's kind of, everything keeps going to a bigger wave or to greater excesses. It takes more to crank it down, takes it more to get you out of that hole.
Well, and sorry to interrupt, David, but you mentioned the number of the Fed coming in with $20 trillion next time. Does that not bring us to another top after this?
Well, but that's exactly my point. Is it took $5 trillion to get us out of the pandemic? The bear market was 3 weeks. I mean, we went down to 2,200 in the S&P in a matter of 3 weeks. We were down 35% in 3 weeks, I think. And we panicked because obviously we shut down the world economy. And so everybody pumped it up with money and lots of other programs. And surprisingly, we came out of that pretty quickly. I mean, I was one of the few that was bullish as a result of what they were doing. But then, we've created every Fed reaction creates the opposite event, right? It may take several years, but it creates the opposite. So we had, what everybody called ZIRP, zero interest rate policy for so long, but it was a lot of money coming along with that. So this time around, we've got a 2008-9 was unlike anything we'd ever seen in our history in terms of debt, in terms of leverage, et cetera. Guess what? We're here in 2025. Leverage is way beyond 2008 and 9. Both in terms of debt, which is $330 trillion in global debt, and in terms of derivatives, which are quadrillions in notional value of derivatives. So as I say, debt is the leverage on the economy, on the financial system, and derivatives are the leverage on the markets. And so I think, given that we have, we're moving to this extreme where, it's taken so much money to get us out of the hole, I think we're at that point where, if I'm right, that we're not only going to have a recession, but a global bust, which I define as bigger than 2008-9. It's then, and we have central banks, particularly Powell, but particularly the Fed, but central banks around the world saying, we don't want to repeat the mistakes of this last decade. We do not want to go back to ZIRP policy. And that's why people think he's just being political. I think it's more he's fighting the last war. He's saying, we got so criticized as an institution in terms of, keeping rates at zero for so long and creating the opposite problem, that this day he's already promised us he's not going back to it. He's not going to be the Fed put, going back to this huge QE. So in his mind, that's done. That policy's gone. The problem is, that's easy to say until you see something staring in your face, that the only thing you have is money. And that's what I believe is coming, is that we will have a global bust, meaning bank failures dominoing across the world. And the central banks will have no choice, because there's nothing else that can move quick enough to save that. They'll have no choice but to print money. And they'll start, as I say, the Fed will probably start in response to a recession. They'll say, well, we have to ease here. We're letting up on the brakes on money. We've lowered rates. We started to lower rates, but we also have to start doing some QE. But we're not going to do what we did before. So we'll do maybe $1 trillion. And we're not going to do $5 trillion. And then they look in another month and it didn't do any good. Things are still falling. And so several times they'll go to, now we're going to do a couple of trillion more, but we're not going to 5. It'll take them probably 8 or 10 months to get to a right-sized policy. In the meantime, things are falling apart. And again, I'm using the U.S. as the example, but it's around the world. Mm-hmm. And by the time they realize we can't worry about what it's going to do down the road, we gotta save the system, you'll have put 20 trillion in, is my guess. I mean, it's just a seat of the pants guess, but so you could see a $30 trillion Fed balance sheet by, say, 2027, maybe 2026. And of course, and I think that global bust is going to be a deflationary bust because we're going so far down here. We're not far from, if you listen to Trueflation, we're not far from 1% now. So you get a bust, you're surely going to be in negative inflation. So if you're in negative inflation, that money that's being printed all around the world, 20 trillion here and likewise elsewhere, is going to take a couple years to really show up as big inflation. Your first year out, you might be back into positive territory of a couple percent. The second year, you might be moving up pretty quickly and being, above 6%, maybe on the way to double digits. By the third year into the recovery, you're well past 10% and on your way to 20. And I estimate by the early 2030s, we could be looking at 25% inflation in this country. So if you're going from negative inflation to, let's say, 10% within 2 to 3 years and to 20 or 25% within 5 years, what's that going to do to PE multiples? Well, the reason we had this bull market from 1982, the reason I say this is a 43-year secular bull market, is 1982 was the start of the disinflationary trend where PE multiples expanded from single digits to all the way up to now 23 times the market multiple. If you get the reverse of that, and that all that time we ratcheted inflation down from 20% to 1% so far on the way to negative. If you get the reverse of that in the next 1, 2, 3, 4, 5 years, you're going to see that PE multiples shrink, even though there's going to be earnings because of all that money printed. So you're going to have particularly the commodity sector and the industrial sector do very well. I'm predicting gold go to 20,000 by the early next decade. Silver go to probably 500. Oil go to 500 a barrel. So you're going to have sectors that are going to be doing very well. But look at all the growth sectors that have done well this cycle. They aren't going to be the winners next cycle because you're going to have interest rates go with inflation from zero. I think the 10-year will get to zero in the bust, go from zero to almost 20%. And if you have that, your multiples are going the opposite direction. So even if you have earnings, it's going to be capitalized at ever higher rates, and therefore your P multiples shrink. That's why I think we're at the all-time peak. And I have said many times, I don't think the peak this cycle, wherever it is, I'm saying 8,700 on the S&P, maybe I'm still too low. I don't know. I think it's pretty high. But I think going forward the next couple decades, you're not going to come close to that number. Whatever the number is this cycle, you might get coming out of a bottom. If you get an 80% bear market, as I'm calling for, coming out of that bottom, you could have a triple or a quadruple off that bottom and still be far from the 8,000 or 9,000 on the S&P.
Right. David, when we think about the going into this final top here, let's just take that time frame in particular here. What do you see as the reaction from, let's say, gold and Bitcoin, for example? These are assets that are very tied to, let's say, interest rates, to confidence in the market. How do you think they react going into that top?
Yeah, so going into the top, I'm calling for gold to go to 4,000. Okay. We rose from 2,500 in 9 months, I think. Maybe it was less than that. We went from 2,500 to 3,500, so rose 1,000 points. And then we've spent the last 3 months consolidating that gain. I think you're very close to a liftoff in gold again that could take it to 4,000 in that same, but certainly this year. Gold might go beyond the stock market top because the top can build for a few months. So I'm saying you probably see 4,000 gold by the end of this year. Silver, same story. It took a long time to get going, but silver just today, I think, is at a 14-year high. It surpassed highs in 2011. Not the high of 2011, but that was the last time it was at this level. So I think silver is getting going, and as I said, I think it can go to 75 this year. Then in the bust, I think almost all assets other than treasuries get hit. And I think, silver is a much more cyclical metal than is gold. So I'm thinking that'll be more volatile to the downside. So you could even see silver, if the stock market's down 80%, silver might be down 70%. Who knows? But from 75 to 70, down 70% is, what is that? Probably 2,200. So, 2,200. So it's still, it's not down at 500 or 1,000 or anything, and gold probably doesn't lose more than 50%, maybe 40%, who knows? Because it's more of a run to safety metal. People do use it for some defense purposes, but if you go to 4,000 and you correct 50%, you're back to 2,000, right? So, and that would make sense, or close to that, because that was the breakout. We broke above 2,100, and then that was where we took off. So I could see that. So as I say to people, those who think you're real believers in the long-term story in metals, and I am. If you buy and hold them, you might not be a very happy camper next year. Because those are pretty big swings. On the other hand, there's a huge story on the other side of that. So everybody has to make that decision. But I think, the market's going to be down 80. These things will probably be down less than that, but still be down big.
David, as we think about, let's say, the proxies to the gold or silver price here, and especially if we see, $4,000 gold and $75 silver, what does that do you think to the mining sector going into this top as well?
The miners are finally starting to catch up. They've lagged for a long time. They frustrated a lot of investors. I think you're in for a pretty good run here. Actually, I raised my GDX target. It had been 65, and I just think there's more runway ahead. So I raised it 75, and I'm not sure that's high enough. My GDXJ target was 100. I kept it there because there's still a ways to go. That probably could exceed that. My SIL, which is large cap silvers, was 75. I left it at 75. And same thing with SILJ. I have a 35 target. That's the farthest one away. It still would need to go up more than two times from here. And I left it there. But I think the silver miners, the gold and silver miners both, I think are going to do very well here in the next 6 months.
And to contrast that, I've seen that you're calling for oil, basically, oil drillers and let's say the picks and shovels of the oil industry to not kind of follow suit in that same way, right?
Yeah, I've been a bear on oil since 130. I was actually a bear probably before that. I didn't see that run up. Obviously, didn't anticipate the invasion, but from 130, I've been consistently the bear on the street in terms of oil. Initially saying it could go back to 85, which is where it took off from, and then when it got down under 100, I lowered that to say it could get into the 60s, and in probably the last year, I've been saying 60 was my target for this period, and then in the bust, I think it can go to 30. So, it was amazing to me to watch Street stay bullish on oil all the way through. They thought I was crazy to be talking down there. Well, obviously we got there. And it was mostly a story of excess supply, and knowing that the economy around the world was soft. so you had a supply-demand situation that argued that oil was not going to do what everybody thought it would do late cycle. Mm-hmm. And that's still my view. I think, obviously, you got a pretty good bounce because of, the Middle East. And, you can still get some of those along the way here if the Houthis do something in the Straits, et cetera. But ultimately, I think you're going to be in a trading range here until we top out between probably the mid-50s and the mid-60s, or mid-50s and 70. And then from there, when the bust hits, I think we go all the way down to 30. And down there, and obviously it could even undercut given what happened last cycle, but down there, to me, energy is going to be one of the huge winners, and oil is going to be one of the huge winners of the next cycle. If we go from 30 to 500, you want to own an awful lot of oil stocks.
Mm-hmm. David, I want to go back to talking a little bit about the structure of this global bust. You mentioned the quadrillions in derivatives, and considering the amount of basically the rest of the world that is invested in not only US dollars, but also US assets like the stock market. Do you think that is what really drives the rest of the world into this global bust alongside, let's say, the US?
Yeah, I'm not sure. It's you look at Europe, for example. I mean, we get frustrated with both the U.S. and Canada, and probably more so in Canada, but we get frustrated with the socialistic policies here, and yet you go over to Europe and it's far worse. And the whole concept of bringing the continent together under the EU and then forcing policies on all of them. Obviously, the UK kind of pulled away from that. I think Italy would love to pull away from that, probably Spain too. But it has left, if we have imbalances and excesses here and lack of productivity, et cetera, they have it 10 times worse over there. So I think there's a lot of, 2008-9 created a lot of fragility. We've come out of that. We printed our way out of it, et cetera, but didn't take away some of the underlying things that didn't get fixed. And then we got hit by the pandemic. And I keep arguing that there's fragility in the system. Look at the fragility in terms of energy policy in Europe. I mean, we dodged a bullet there for a little while. It was, there was a dire story for a while where you didn't know if they'd have energy for the winter, et cetera. There's still a problem there, right? I mean, their policies have led to a real problem. I think there's an awful lot of people living kind of just hand to mouth. Certainly there are in the U.S., and I think there are probably even more so over in Canada, even though they have this so-called safety net and everything. You're running out of resources. You can't keep pretending that you can do things so inefficiently and it doesn't lead to excesses that lead to a bust. So I think, and you can say the same thing. I mean, China covers up a lot of their problems, but they've got big problems right now. Probably the one that really, from a leverage standpoint, is the scariest is Japan, right? I mean, they pursued this policy where they could have their cake and eat it too and keep interest rates at zero for far longer than anybody else did. And you kept wondering when that was going to come to an end. Monetary theory is still real. And all of a sudden now you're seeing rates are pushing up, inflation's pushing up, and they've got a far more leveraged system because of the game they played for a couple decades. And so I think during the bust, that's one of the wild cards is if rates start moving up there and they can't control them, what do? I mean, they're out of answers. And they're going to have to, everybody talks about modern monetary theory and yield curve control. What they didn't live through that I lived through certainly in the early 80s is once inflation breaks out, you don't have the printing press. You don't have the control that you have when everything's kind of, inflation's kind of contained. And that's really my story for the world and for the U.S. in the 2030s, but it could be the story for Japan in this downturn.
Mm-hmm. Before we hit record here this morning, David, you said that you're a big believer in supply side economics. And obviously, Trump is very focused on trying to bring manufacturing back into the States, trying to resolve some of these trade imbalances that the U.S. has by implementing these tariffs. How successful do you think that is going to be, or is it ultimately going to prove, kind of an odd footnote to this time that is going to be dominated by this monetary and debt cycle, rather than any success that comes from this change in strategy that he's trying to implement?
Yeah, that's a great question. I struggle because I've got the most dire forecast of anybody on the street in terms of this global bust. And yet I'm very optimistic about what Trump is trying to do and what he is doing. That big, beautiful bill, which really gets to your question, Wall Street really kind of was negative towards it, to say the least. And everybody was arguing the rates are going up because of it. And, we didn't do anything to answer the deficit. And that's where the conversation about supply side economics comes in, is I think for the first time since probably Reagan, we're doing the right thing in terms of understanding that revenues are not the revenues are the only way you're going to solve this, because our spending issues are just too many of them are kind of baked in the cake. So we dance around. Every president does this, and every Congress does this. We dance around like we're going to solve deficit problem by cutting the growth in spending. We're not going to cut spending, but we're going to do a little bit here or there, and it ends up deficits go ever bigger. We keep pretending like it's infinite, that our resources are infinite. The only thing that really can solve that, or has any hope of solving that, is if you can grow the economy and get revenues that run faster than the debt runs, the spending runs. And I think that's the big beautiful bill. We fall for this every time. CBO uses a static model. Most economists on the street use a static model. And the only way they think they can bring deficits down, is to raise taxes, maybe cut a little spending. But that's not really the story, because nobody's willing to attack Social Security or the entitlements, right? So if you're not going to do that, that's a huge part of the budget. If you need military to remain strong, you're not going to cut there. You're going to expand there. Discretionary spending, you're just not going to solve a deficit problem of the size of ours, particularly given the waste we had in this last administration, and also a little bit of Trump during the reaction to the pandemic. You blew the deficit sky high because of the fears, and the games played on climate change, et cetera. So you can't solve that problem just by spending. And so everybody's disappointed because it really looks like, on a static basis, deficits are going higher. But if you look at what, and the Trump people really believe in this, this is not a game. This is not business as usual where they want to keep government growing, and so they tell you a lie. They are right, I believe, economically, that if you deregulate to the tune he's deregulating, if you expand energy to the tune, fossil fuel energy particularly, to the tune he's doing that, if you reshore here by forcing other countries to treat us as, much more like we've treated them, open their economies, and if they don't, then focus on bringing back manufacturing here. If you do all those things, and that was part of the big beautiful bill. And if you secure your borders, you can actually turn this thing around and make it work. I'm, as I said, I fight myself because I really believe we're so far along and towards that global bust. that I don't think it can happen fast enough to offset that or to head that off. I might be wrong. Maybe we'll get lucky, but I don't think so. So I think most of what you got to hope for and what I believe could happen is after the bust. The bust is, in my opinion, kind of like 2008-9. It's 12 to 18 months of pretty bad times, but we come out of it because of all that money printing. We come out of it. It's during that recovery, and we will have a recovery cycle because of all that money and because of some of these policies. It's during that recovery period where the U.S. can really make some inroads against the deficit and against, the bad policies that have been in place for decade after decade after decade. So I'm a big believer in what he's trying to do, though the wild card is how much of it will be able to happen, and not be overwhelmed by the bust and all the policies that go into that. Because monetary policy is going to dwarf everything else. I mean, if you print $20 trillion, I don't care what fiscal policies you have. Monetary policy is going to be the big story of the next cycle, but it is it will lead to a recovery. That's the thing that I really do believe very much in money. You print enough money, you're going to come out of the hole. I'm not worried about that. And if you are deregulating at the same time, and you are reshoring at the same time, and you're doing some of these things that are productive rather than counterproductive, which government's usually doing, you can actually maybe head off my real dire forecast, which is a total collapse of the global system in the mid-30s. That's down the road, but because of the money printed, I'm worried that and I believe that you're going to get this massive run-up in inflation, massive run-up in interest rates. And once you get that, this is jumping forward to the 2030s, but if you're dealing with it then, there's no answer because you've basically shut down the printing press, right? If you've got high inflation, maybe not Weimar levels, but 25% pretty high, and it'll start well before that at 12, 13, 14%, you're not going to be able to print money because money just runs inflation even hotter. Mm-hmm. So once you take printing presses away from these central banks, you stop the Ponzi scheme. You stop what's happened for 80 years. Yes, we've had a printing press that we could run things too hot and then shut them down and then run them again. And each time you're ratcheting up things, under Volcker, under Reagan, through until 2022, you basically disinflated because you understood that particularly under Greenspan, you understood to stop it. He kind of started leaning against the economy sooner back in the 80s and 90s. He understood that leads and lags mean that you can't just look at current. We're back to a Fed chairman that's looking at current, right? He's not trying to go the opposite way of what current tells you. He should be easing now. He's far too restrictive. Part of the reason we'll have a bust is because he's fighting the last war, and he's more worried about inflation than he is, the downturn. Well, guess what? When you've got leverage off the charts, being late is bad. When you don't have leverage, when you have leverage off the charts, being late means things happen fast. Mm-hmm. Means the unwind happens very fast. So, they're looking at, think about it, I'm jumping around here, but think about it. They're looking at jobs as one of their primary things. Obviously, it's one of their mandates, but they're trying to determine policy by looking at one of the most lagging indicators we have. Jobs comes later. The economy turns down, and then you get more jobs issues, layoffs, et cetera. So if you've already got a 6 to 9 month lag to policy to when policy kicks into the economy, and then you pick, instead of a leading indicator or lagging indicator, you're stretching it that much more. They talk like today's economy is what they should run policy by. No, mm-hmm. You're way late by doing that.
David, when we think about basically the playbook. You just mentioned trying to play today's economy. When we think about the playbook that is typical, let's say, of, again, history or informed by history, typically we see countries go to war in times like that, where they have, massive deficits, and it's almost a way to try and stimulate the economy. Do you think there's more conflict as well that comes in these types of times, in these types of boom and bust cycles, that play a big role in this as well?
Yeah, certainly. I don't think that's in Trump's mindset. I don't think for the bust, I don't think that's likely. It's possible, I guess. We've got certainly things happening around the world that could accelerate. I think it's more. I'd be more worried about that being the playbook for Xi and China, because they got problems over there, and maybe trying to distract their people through Taiwan, or things like that. Yeah, that's certainly a risk, and we would obviously be the other side of that, so we'd be part of it. I worry more about that, or I think that's more likely in the next cycle. The bust is a cycle where we have a recovery following it. The next cycle, I believe, we're going to be going towards collapse, because we have basically eliminated the printing press as a tool. So then I think the whole basically financial system around the world that we've built up over, certainly since Bretton Woods and before, I think that collapses. But during that, you certainly could see, we got to run we got to have war to pull us out of this, because I think there's going to be not too many answers for what's coming then. So I'd worry more about it then, but it certainly there is the risk of what's going on in the Middle East or what's going on in Ukraine, getting pulled, dragged into, and pulling more countries into that, more of a, NATO getting more involved, et cetera, the U.S. getting involved. I think that's a risk. I don't think that's all that likely this time around. Taiwan, you always worry about that, because it is, I think China knows our vulnerability there. But yeah,
going back to NATO, that's what I was going to ask is, obviously China is a risk. I think we understand that, but what about Europe? Like, it seems like no matter what they want, again, it just seems like they want more of that conflict in Ukraine. We saw a lot of saber rattling from Germany and the UK that they were going to be, sending arms and helping much more and taking a more active role. So, I don't think just being focused on, let's say, Russia or China are the only risks to that ratcheting up of that conflict zone.
Yeah, for sure. I mean, it's very hard to know exactly where NATO's coming from. It could be very, straightforward that they do worry that Putin's looking to rebuild the Soviet Union, that Ukraine's his first step, and what's next. Yeah, I think that's a legitimate worry that they have. But then there's the other side of it, which is how much of this are globalists dictating, and they view globalists are basically, in my opinion, anti-Westerners. Even though it's Westerners who are driving it, it's basically pushing us towards communism. Is going to a one world government, going to taking away sovereignty. That's an anti-West type of philosophy. So I view them as basically playing. Are they in bed with the communists, or are they just I don't know what their overall goal is, but there's that piece of how much of our leadership in NATO are globalists or pushing an agenda that is really not the one that everybody thinks it is, or how much of it is legitimate. We're worried about Russia trying to come after us after they get done with Ukraine. So I think that, it's kind of both of those things playing there, and that either one of those obviously means you could see this thing accelerate or get worse.
Mhm. So I've been trying to kind of get you to paint this picture as we move through time here, David. And I want to go back to what you said, that, and I do agree with you that there's not a whole lot that, let's say, $20 trillion can't really start to stimulate. And you said that comes on the monetary side. So do you think that it's possible that they've kind of learned to try to not use the monetary side, considering the inflation that we saw after the last type of monetary stimulus that we got, and rather do it on the fiscal side? And why doesn't that end up leading to another local high that is higher than 8,700 as you're calling for in this top?
Yeah, first of all, I think it'll be both. So I don't, I throw around numbers, and so I don't want people to think I have some magic crystal ball tell me the number. But seat of pants, 20 trillion. Mm-hmm. I would imagine that it may not be matched in total by fiscal, but I think we'll see a lot of new bonds, and fiscal expansion, so that if we have 320 trillion in 330 trillion in global debt today, and again, even though I talk U.S. is happening around the world, I would not be surprised if by 2030 we're looking at 450 to 500 trillion in global debt. A lot of that will be sovereign, or maybe the vast majority will be sovereign debt. So it'll be governments expanding their fiscal. At the same time, they're printing money. So they'll be monetizing debt is what they'll be doing in response to the bust. I don't think there's any way you can expand fiscal without expanding the monetary, because there's not enough buyers. Who's going to buy the debt? I don't think the buyer of last resort is the central bank. They will be monetizing that debt. That's why I kind of laugh when everybody's worried about China not wanting our bonds or Japan selling our bonds. I go, that's a small potatoes compared to what the Fed's going to be buying in the bust. So I think they go hand in hand. It'll be both fiscal and monetary, and so I don't think that. To me, we're past the point where you can talk about inflation being under control for the balance of this decade. Even though I'm saying we're headed for deflation, it's the response to that deflationary bust that gives me so much confidence that we're heading for much higher inflation on the other side of this. So I don't know if that explains entirely what you asked, but
yeah, I don't, like you say, it's hard to see exactly how this plays out, but it's such a complex, in some ways, but yet cyclical game at this point to how currency comes into the system and what that ends up meaning as a result in the markets and also in geopolitical conflicts as well.
Yeah, from my perspective, the easiest part of my forecast is the monetary printing.
Yeah.
The most predictable.
Yeah.
Because it's basically saying, I know what the response will be if they're faced with, if I'm right about a bust, the response is very predictable. They don't have, like I said, they're going to be late because they don't want to do this. If you ask Powell today, he'd tell you, no way are we ever going to print money like that again. Mm-hmm. And he'd be very honest with you. I don't think there's a central banker out there today that believes my scenario is going to happen, because they don't realize what we're headed for. It's easy to talk about discipline and not going back to what we did in the last decade until you're faced with a system that's about to collapse. You're watching banks, big banks around the world, failing. And you can't say, well, what are we going to do? Let's see, maybe we can come up with a policy. Let's turn this over to Congress and let them figure out what they can do about it. The only thing that will move this fast enough to save the system is printing money. So it's a given. They will be deer in headlights going, oh my God, we've got to, just like you saw in 2020, except times 4, they're going to have to print money. And again, Lagarde's going to be doing the same thing. Bank of England's going to be doing the same thing. Bank of Canada's going to be doing the same thing. Bank of Japan, People's Bank of China, they'll all be doing it because they don't have a choice. So that part, I don't have any doubt we're going to see. The question is, am I right about how dire how much of a bust we get, whether we'll get a bust? If we get the bust, I think that follows. And then, I also don't have any doubt, some people do, that if you print enough money, you pull yourself out of it. Because when you're in the midst of that, you're going to have plenty of voices saying, yeah, they're printing money, but who says that's going to do anything, And there are going to be all these theories about, you're pushing on a string. You can't make people spend money. When you get to this level, there's people lose hope and they're not going to. I don't worry about any of that. Money will overwhelm the system at some point. It may take 20. It may not overwhelm it at 10. But at some point, if you keep pushing that money out the door, you're going to get a recovery with a lag, 6 to 9 month lag. So to me, those are the easy things. The harder and the other, to me, very predictable thing is that if you print that much money with a lag, you're going to cause hyperinflation. That's the problem. Is it's such a lag that even though people know the theory, but they're not going to be worrying about that when they're faced with collapse. So they're going to, by the time they stop printing money, and by the time they get to anything close to 20 trillion, you've already created the inflation. It just won't show up for a couple of years.
Yeah.
And if you look at it from a non-monetary standpoint of how that plays out, how it works through the system, if we're reshoring, this is why I think the next cycle is all about commodities. If we're, consumers going to be flat on their back. They'll be, they'll come out of this and there'll be some spending on housing and cars and everything. But the bigger picture, the consumer is going to be hit by an 80% hit to the market, maybe a 30 to 40% hit to their home prices, loss of jobs. You probably have double-digit unemployment in the bust. So coming out of it, it's not going to be a consumer-driven cycle. They're going to be digging out for years, right? I'm not saying it's absolute. It's not like there'll be some recovery in consumer, but they're not going to be driving the boat like they have the last 30 years. It's going to be, it's going to go back to a late 70s, early 80s type of cycle because of reshoring, because Trump is doing all this to bring manufacturing back here. Manufacturing takes a lot of commodities, right? So you're going to have $20 trillion is going to ramp up demand for plant and equipment and everything else. And we don't have the commodity supplies to meet that. If it ramps up over the next 3, 4, 5 years after the bust, it takes sometimes 10 or 15 years for a new mine to be developed or a new oil field to be developed or what have you. You're going to have the demand for these products go up very fast, 2 or 3 years after the printing, and yet supply can't meet it. So what it gives is price. That's why I can say oil will go to 500, or natural gas could go to 50, or copper could go to 20 or 30. Who knows? And people go, well, how that can't happen because people can't exist in that. I go, that's what we will, if you said that in 1970, you would have been shocked at what oil did in the late 70s. It happens, and then some things can adjust and other things don't. There'll be substitutes. There'll be some things that allow you to at least exist, but it is going to hurt standard of living for sure.
Mm-hmm. Yeah, I think there's no avoiding that in this type of scenario.
Exactly.
Well, David, I think that's a good kind of place to put a pin in it for today. Of course, you're available on Twitter at Dave H. Contrarian, and you also do that newsletter, as you mentioned, right?
Yeah, I do. I'm on Twitter most every day, so I say this in my interviews now. There are a lot of people that, if their settings aren't set right, they're looking for original tweets, and most of my stuff are replies to other people answering questions or commenting on things, and that's how I communicate. So if you are only set to see original posts, you're going to be missing a lot because I'm on there every day, probably 20, 30, 40 comments a day or more. And I'll have people who I'll post something and they'll go, I haven't seen you in 6 months. Where have you been? And I'll go, I was here yesterday, So just know you have to kind of get your settings right where you're able to see replies. And I won't go into how because I'm not an expert on that. But and then I do write the quarterly macro letter that is available by subscription. Anybody, it is for both retail institutions. I've had probably in the last 5 years a lot of retail sign up for it and have told me it's easily understandable. So it's, even though it's Wall Street speak, I speak pretty plainly, I think. So if people are interested in that, like I said, there's a cost to it. They can direct message me on Twitter or on X, and I'll give them details.
Perfect. Excellent, David. Thanks so much for your time today.
Yeah, thanks, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.